Welcome back to the deep dive. Today, we're doing something a little different. We are not just, summarizing financial trends or reading out stock predictions.
Yeah.
We are designing the operating system for your unburdened future. We're basically tearing up that old script that says the only way to get wealthy is to grind harder, work longer, or, take on all this unsustainable risk.
That's the essential shift we're making today, isn't it? For so long, the whole financial conversation has been focused on one thing,
Right.
maximizing income.
Always more.
But what if? What if the true key to unlocking massive wealth isn't earning an extra $50,000, but actually wanting less?
I love that.
We're living in this world that's just defined by financial and information overload. And frankly, succeeding in 2026 is going to demand a much leaner, more intentional approach.
I love that framing. It's like we're challenging the whole conventional wisdom of consumption.
Yep.
So our deep dive today is focused completely on the Minimalist Wealth Blueprint for 2026. And this strategy, it's a pretty sophisticated pairing of two distinct but mutually reinforcing disciplines. First, radical frugality, which we're defining as intentional underconsumption. And second, a very, very disciplined approach to strategic digital asset allocation.
And that convergence, as the research we've synthesized shows, is really the shortcut. It creates this massive intentional capital surplus faster than just relying on, organic income growth alone.
And then it deploys it.
And then it deploys that surplus into the most efficient, most transparent assets available today.
So our mission today is to just extract the concrete, actionable steps for you to achieve this robust yet financially lightweight future. We're pulling together concepts from high-level macroeconomic forecasts, some deep dives into behavioral science, which is so critical, as we'll get into.
Yeah, absolutely.
And the rapid institutionalization of digital finance. We're pulling all these insights from extensive analysis, most notably the research compiled in the 2026 Minimalist Wealth Blueprint, Strategic Frugality and Digital Asset Convergence, which aggregates consensus forecasts from major players like the IMF, Morgan Stanley, JP Morgan, and, of course, leading research on behavioral and digital finance.
Think of this as your personal blueprint to leverage the shifting macro environment. It's not just about working harder with your money. It's about mastering the art of working smarter with your capital, and maybe most importantly, mastering your own mind.
Okay, let's unpack this with our key concept one, the macro context. I mean, before we can deploy a single dollar, we have to understand the sandbox we're all playing in for 2026. The sources are calling this year the year of risk reboot.
That term risk reboot is so telling. It really signifies a global transition away from the structural anxieties that began in 23 and 2024.
The rapid inflation, the crazy interest rate hikes.
Exactly. All of that. We're moving into a new regime that's more focused on consolidation and moderate efficiency gains. The consensus forecast, pulling from institutions like the International Monetary Fund, projects pretty moderate global GDP growth in a conservative range of, say, 3.1 to 3.2%.
So we're firmly planted in what the economists call the soft landing scenario.
We are. That's the idea.
And crucially, that intense inflationary pressure we've all been feeling is expected to keep cooling down, which is, I think, welcome news for literally everyone.
It is. The forecast sees global headline inflation coming down further, settling somewhere around 4.5% globally. Now, that's still a bit elevated compared to the long-term historical norm, but it's a huge improvement over the peaks we saw.
Okay, now here's where the story gets a little more nuanced for the individual investor, right? The policy divergence.
Right. We're seeing this policy triumvirate in action fiscal stimulus, monetary easing, and regulatory shifts. But the trajectories are splitting, and splitting dramatically between the major economic blocs.
Like the U.S. versus Europe.
Precisely. The U.S., for instance, is anticipated to show some significant resilience. This is supported by two main factors. One, the robust U.S. consumer, who has surprisingly maintained their spending power, and two, early tangible productivity gains coming from the widespread adoption of AI tech across corporate America.
So what does that mean for the Fed? Because interest rates, that has been the one lever dominating everything in global finance.
It means that whole higher for longer narrative is finally fading. The Fed's preferred inflation measure, core PCE, is forecast to end 2026 at a pretty manageable 2.6%.
Okay.
Given the successful cooling, the Fed is anticipated to reduce interest rates strategically, back down to a neutral range of 3.0 to 3.25% by about mid-2026.
So this isn't a return to zero interest rates.
No, not at all.
Yeah.
But it is an intentional, controlled easing that gives capital markets a much more stable footing to stand on.
But the Eurozone, that tells a completely different story, doesn't it?
Completely. If you look across the Atlantic, the European Central Bank, the ECB, is likely to pursue more aggressive rate cuts. They could take their rate down substantially, maybe to around 1.5%.
Wow, that's a big drop.
It is. And it's because of significantly slower regional growth, which is forecast between a pretty sluggish 1.1 and 1.5%. This is that divergence in action. It reflects these really deep entrenched structural headwinds and energy dependency issues that are still weighing so heavily on their economy.
So the overall implication for us, for you listening, pursuing this minimalist wealth blueprint is profound. Capital is getting back to a stable environment, but the global economy is still fragmented and subject to what the sources call unending volatility from geopolitical tensions and these regional slowdowns.
Which is why this environment absolutely necessitates what we're calling the minimalist mandate.
Okay, what is that?
The minimalist mandate basically states that because capital is not free, and because this external volatility is just the new norm, the only way to generate robust, predictable wealth is through radical internal efficiency.
Efficiency in what?
Both in how you select your assets and, maybe more fundamentally, in how you manage your spending.
Which brings us perfectly to radical frugality as a wealth multiplier. And we are talking about so much more than just clipping coupons here.
This is where we completely flip the script. Frugalism, in this 2026 paradigm, is a philosophical shift. It is defined as intentional underconsumption.
Underconsumption.
It's not about being cheap. It's about aligning every single expenditure with your deepest values. And this philosophy has gained massive traction among younger generations, millennials and Gen Z professionals,
Sure.
who see it as the clearest, fastest path to financial autonomy. It's a refusal to be held captive by a consumer culture that just demands continuous debt accumulation.
I often think of it as you're buying back your future time. Every dollar you choose not to spend today is a dollar that gets invested and generates future freedom.
That's it, exactly.
But the primary enemy of this freedom is so insidious. Lifestyle creep.
The sources explicitly identify lifestyle creep as the single most common financial pitfall that derails otherwise intelligent, high-earning individuals in 2026. The pattern is so predictable.
I think we've all seen it.
Oh, yeah. As your income rises, you get a raise,
Yeah.
big bonus, a new job. The default psychological impulse is to immediately increase your spending to match it.
That new six-figure salary suddenly justifies the $80,000 car lease or the bigger house in the slightly better neighborhood. But then the resulting debt just absorbs 90% of the raise, leaving you financially no better off, but with a lot more stress.
It's the financial treadmill in action. You just never get ahead because you're continuously upgrading your material life to match your paycheck. The Minimalist Blueprint offers a structural counter-strategy to this. The season of sacrifice.
Okay, that sounds intense but necessary. What exactly is the season of sacrifice?
It is a deliberate, time-bound, hyper-focused period, usually 3 to 6 months, that's dedicated to maximum saving. You commit to living a really quiet life, intentionally keeping your spending at a lower value-aligned level, even as your income might be significantly increasing.
And the goal is just acceleration.
The sole aggressive goal is to accelerate the growth of your foundational capital.
Let's put some numbers on this for you listening. Let's say you manage to save an extra $500 a month by radically cutting back on dining out, subscriptions, new clothes. Over a year, that's $6,000, right?
Exactly. But in the season of sacrifice, you might push that savings rate to an extra $1,000, maybe even $1,500 a month for 3 straight months.
And that lump sum is key.
That foundational capital, that $3,000 to $4,500 surplus, is what immediately funds the digital asset allocation we're going to talk about later. It lets you enter the highest yielding asset classes much, much sooner, and that creates an exponential advantage.
So we're contrasting the traditional view, which is all status-driven acquisition, always needing the next material symbol, with the minimalist 2026 paradigm, which is built on underconsumption and purely values-based spending.
And the strategic outcome is twofold. First, You get the quantitative result of a high savings rate, which just accelerates your wealth accumulation.
The numbers.
The numbers.
Yeah.
And second, you get the qualitative benefit of lower stress and anxiety. When you're not constantly caught in that consumer comparison game,
Yeah.
that psychological pressure to keep up with the perceived success of others, you free up a massive amount of mental bandwidth.
And that mental bandwidth, that behavioral resilience, is the absolute bedrock of this entire system. It's a perfect bridge to our next key concept. I mean, you can have the perfect investment strategy, but if you can't execute it when you're under stress, it's completely worthless.
Exactly.
You know, all of this efficiency we're talking about, curtailing spending, making smart investments, it all relies on one thing, us being rational. But as you constantly point out, our brains, they often sabotage our best financial intentions.
That's the hard truth of financial science, isn't it? The sources are definitive on this. Financial decisions are only about 20% knowledge and a staggering 80% behavior.
80%.
We are profoundly shaped by emotions, by deeply ingrained habits, and most frequently by these cognitive biases or heuristics that we're not even aware we have.
So this is where we have to stop treating finance like math and start treating it like psychology.
Precisely. Let's start with a huge psychological barrier in volatile markets: loss aversion. Humans are biologically wired to feel the pain of a loss approximately twice as intensely as the pleasure of an equivalent gain. And this just drives intensely irrational behavior.
I've seen this personally and professionally so many times. Markets drop 10%, which is an entirely normal, even healthy correction. And suddenly you're panicking, you're selling your long-term holdings at the absolute bottom and locking in a loss you didn't even have to realize.
Yes.
The immediate pain of that drop just completely overrides the long-term rational projection of future growth.
Or you can consider the flip side: the refusal to sell a depreciating asset, a loser, just because you're determined to wait for it to get back to its previous peak, even if the fundamentals of that asset have permanently changed for the worse.
Right, trying to get your money back.
That is loss aversion telling you don't realize the pain. By holding on to that dying asset, you miss the opportunity to redeploy that capital efficiently into a high-growth area. It's the very expensive emotional habit.
And then there's the hidden systemic drain that impacts even the most disciplined investor: financial decision fatigue.
Decision fatigue is it's the deterioration of your decision quality that happens under cognitive load. When you spend all day making complex choices, what to eat, what to prioritize at work, how to manage your family's schedule, your willpower and your ability to make rational long-term financial choices just diminish significantly.
And money decisions are the hardest because they involve risk assessment, probability, delayed gratification. It's just mentally exhausting.
And when that fatigue sets in, the brain just seeks the path of least resistance.
Right.
And that path is never the spreadsheet or the long-term retirement goal. It's usually an impulsive, immediately gratifying online purchase, or just avoiding necessary financial planning altogether, pushing it off till tomorrow.
Which leads to inertia.
Exactly. The Minimalist Blueprint recognizes that we cannot simply willpower our way through this. We have to architect our environment.
So if our default state is irrationality and fatigue, the solution has to be structural. We need to basically outsource the decision-making process to a structured system, what the sources are calling decision architecture. We are designing guardrails to protect future you from present you.
The first and maybe the most vital guardrail is the automation of decisions. This is completely non-negotiable. You must automate savings, you must automate investment contributions, and you must automate your bill payments.
It takes the emotion out of it.
It removes the need for constant low-level involvement, which preserves your precious mental energy for high-level strategic review, like checking in on those macro risks.
It makes good financial decisions effortless, or at least as close to effortless as you can get. The money just disappears into the wealth machine before you even have a chance to budget for that impulse purchase.
The second guardrail is behavioral and, I think, brilliant: the sleep test. You implement a mandatory 24-hour waiting period for any financial decision that involves more than 1% of your current net worth.
I love that. So if you're emotional, you're tired, you're reacting to some sensational news headline, or you're feeling market FOMO, you are legally to yourself not allowed to pull the trigger.
Exactly. That pause acts as this powerful mental friction layer. It forces the prefrontal cortex, the rational part of your brain, to re-engage after the immediate emotional wave has passed. You have to literally sleep on the new car purchase, the large stock trade, or the expensive vacation plan.
Okay, what's next?
Next, we have zero-sum budgeting. This ensures maximum intentionality. Every single dollar, as soon as it's received, must be assigned a specific purpose: its bills, its investments, its savings, or its intentional fund money.
So no unallocated funds?
The goal is to minimize unallocated funds just floating around in a checking account, which are overwhelmingly prone to that impulsive, fatigue-driven spending we just talked about.
It's closing all the potential leakage points in your financial plumbing.
And finally, the most tactile guardrail: tactile feedback. For non-essential discretionary purchases like coffee, takeout, impulse buys, the blueprint suggests reintroducing cash.
Oh, that sounds so old-fashioned.
It does, but it works precisely because it creates friction. You physically feel the difference between mindlessly swiping a plastic card versus watching crisp $20 bills disappear from your wallet.
That is fascinating. The minimalist blueprint really shifts the focus entirely from the market to the mind. That glycological resilience is the foundation that allows the next step, strategic allocation, to actually work and compound without being interrupted by emotional self-sabotage.
Right. With the behavioral foundation secured, we can now move to key concept 3, strategic allocation. This is about moving beyond just generalized investments and adopting strategies that maximize transparency, customization, and efficiency.
Okay, we are leveraging two major forces here: the evolution of customization in traditional equity through direct indexing, and the institutionalization of digital assets.
Okay, let's start with the traditional side. We're seeing a really significant shift away from those generic, passively managed ETFs, which have dominated for a decade, toward direct indexing, DI, for more sophisticated retail investors and high net worth clients. Why this sudden move to this more complex approach?
Well, the move is driven by the demand for hyper-customization and, critically, for tax efficiency. Direct indexing fundamentally changes the ownership structure.
How so?
Instead of buying shares of a pooled fund that tracks an index like the S&P 500, you are owning the individual underlying stocks of that index directly in your own account. It's like owning the 500 individual ingredients, not just buying the pre-mixed cake batter.
So you're building your own personalized index fund, stock by stock. And the analysis suggests this strategy is just exploding in popularity, projected to reach something like $800 billion in assets because of the benefits it unlocks. The primary, massive driver, as the sources outline, is enhanced tax efficiency through superior tax loss harvesting, TLH.
Okay.
With a standard ETF, if the entire index drops, you have a loss, sure, but you can't optimize the individual components within the fund.
But with direct indexing, you own the underlying stocks. So walk us through how that precision radically changes the tax benefit.
Because you hold the individual components, Apple, Microsoft, Amazon, you can execute with surgical precision. Let's say the S&P 500 is flat for the year, but 5 specific stocks in your basket are down 30% below your purchase price.
Right.
You can sell those specific losers, harvesting the capital loss, while immediately replacing them with highly correlated stocks to maintain your overall index exposure. This is key. You maintain market exposure, but you generate a tax benefit.
So that loss generation becomes a continuous, proactive income generator. How significant can the impact be?
The harvested losses can then offset any capital gains you realized elsewhere, say, from selling a profitable rental property or cashing out an early investment. But here's the most critical detail for you listening. You can also use up to $3,000 of those net harvested losses annually to offset your ordinary income, which is taxed at a much higher rate.
And any excess loss beyond that $3,000 just carries forward.
Indefinitely. This turns market volatility into a strategic tax asset.
So if I realize a $20,000 capital loss through DI in a down year, I can offset $3,000 of my salary income this year and carry forward the remaining $17,000 to offset future capital gains. It's like a perpetual built-in tax hedge.
Exactly. Research suggests this can be incredibly powerful, potentially doubling the amount of tax losses harvested compared to just trying to switch between similar ETFs. For high net worth individuals, the tax savings can easily offset the slightly higher management fees that come with it.
And beyond taxes, you mentioned customization. This speaks directly to that minimalist intentional approach.
It allows your portfolio to align perfectly with your personal values or to manage idiosyncratic risk. Let's say you are an environmentally conscious investor.
Okay.
You can instruct your direct indexing platform to automatically exclude the top 10 companies with the highest carbon emissions from your equity exposure. That's an ESG alignment that is simply impossible with a traditional generalized ETF.
Or, here's another one. Maybe you work at a major tech company and you hold significant restricted stock units, creating a massive, concentrated position in one single name.
Great example. You can then instruct your DI account to exclude that company's stock from your broader market index exposure. This strategically reduces your overconcentration risk, ensuring that your core investment portfolio truly acts as a diversified anchor, rather than just exacerbating your existing exposure.
This level of intentional design is really what separates the minimalist blueprint from generalized advice. Okay, let's pivot to the digital frontier, because this is where the rapid deployment of that capital surplus from radical frugality is targeted. The blueprint calls 2026 the dawn of the institutional era for digital assets.
This is such a critical context. Digital assets are fundamentally changing their status. They're moving out of the speculative fringe and aggressively integrating into mainstream financial infrastructure.
What's driving that?
It's being driven by global regulatory clarity. We're seeing comprehensive frameworks like MiCA in Europe, and we're anticipating significant bipartisan crypto legislation in the U.S., which provides the institutional certainty that was missing before.
And we are seeing the big names responding to that.
Absolutely. Institutions like Morgan Stanley, Merrill Lynch, asset managers like BlackRock, they are standardizing access to this asset class for their clients. This institutional validation is the engine that's driving the 2026 allocation strategy.
So the core allocation is lean, it's focused on utility, and it's backed by this institutional acceptance.
Yes.
What are the two essential pillars of this digital core?
First, Bitcoin, allocated 30 to 40% of your risk capital. It remains the essential digital gold. It's viewed as a scarcity-based ballast that's immune to fiat inflation. And with the successful launch of the spot Bitcoin ETFs, providing regulated access for massive pools of institutional capital, it has solidified its position as a standard Treasury reserve asset.
And the price targets from the institutional forecasters are pretty eye-catching.
They are. Consensus forecasts from firms like Bitwise and Grayscale suggest that 2026 will be the year that the classic four-year cycle theory finally breaks down.
Interesting.
It transitions into a sustained bull market driven by institutional demand, where Bitcoin could potentially set new all-time highs comfortably above $125,000.
And that's anchored in its immutable scarcity and these clear institutional rails.
Correct. And the second pillar, Ethereum, allocated 20 to 30%. We think of Bitcoin as the scarce digital asset, but Ethereum is the digital oil, or more accurately, the critical global settlement layer.
And unlike Bitcoin, it has yield.
It has a yield-bearing utility thanks to its proof-of-stake mechanism. By holding and staking ETH, you actively secure the network and you earn ongoing rewards, a real yield generated from transaction fees.
And beyond just the staking rewards, why is Ethereum the go-to platform for all this Wall Street innovation?
It's because of its ongoing scalability upgrades. Specifically, the successful shift to proof-of-stake and the development of these robust Layer 2 solutions like Arbitrum and Optimism.
Right.
These upgrades drastically reduce transaction costs and increase speed, making it the preferred, secure settlement layer for institutions that need to move large values quickly and cheaply without relying on that traditional slow banking infrastructure.
So we have the scarce store of value, which is Bitcoin, and the programmable utility layer, ETH. Now let's get to the convergence point. Real-world assets, RWAs.
RWA tokenization is, I think, arguably the most transformative trend in the 2026 blueprint because it bridges the digital world with traditional finance. It means representing traditional, tangible assets, government bonds, highly rated corporate credit, infrastructure projects, or prime real estate as digital tokens on a public blockchain.
They're calling this hybrid finance, or hybrid FI.
Exactly.
So why should the minimalist investor listening care about buying a digital token that represents an industrial park?
Because it democratizes access and radically enhances efficiency. First, fractional ownership. Tokenization allows you to buy tiny, accessible digital shares of assets, like commercial real estate or private credit funds, that were previously reserved only for institutional investors with multi-million-dollar minimums.
So suddenly those stable, non-correlated assets are accessible to the individual.
It significantly lowers the barrier to entry for these highly lucrative, previously inaccessible asset classes.
Okay, what else?
Second, 247 liquidity and on-chain transparency. Traditional assets are illiquid. I mean, try selling a share of a private real estate partnership on a Sunday afternoon.
Not going to happen.
Right. With RWA tokens, the asset can be traded instantly on a decentralized exchange. And furthermore, every transaction, every ownership record, every collateral valuation is transparent on an immutable ledger, which drastically reduces friction, bureaucracy, and the associated high costs of middlemen.
And the yield component is automated, which plays perfectly into that set it and forget it efficiency ethos of the blueprint.
Yes, the automated yield. Smart contracts, which are just pre-programmed code, can manage complex tasks like coupon payments from bonds or dividend distributions from real estate automatically and transparently to token holders.
And the market scale here is just immense.
Immense. Standard Chartered forecasts the RWA market could hit a staggering $30 trillion by 2034. For you, incorporating RWA tokens, particularly tokenized U.S. Treasuries, into your digital core allows you to access stable, real-world cash flows with the efficiency and transparency of the digital realm.
Since efficiency is really the name of the game, let's look at how we maximize yield on the capital we've allocated, especially that digital component. So, key concept 4 dives into advanced yield mechanics, starting with the evolution of stablecoins.
Right. Stablecoins pegged to the U.S. dollar were, initially just a necessary intermediate step for trading crypto. But the sources show this massive maturation. By 2026, they are no longer just trading mediums. They are robust global settlement rails.
Wow.
They now comprise nearly 30% of all on-chain volume, settling over $4 trillion annually. They are effectively digital high-speed cash with a global reach.
So how does the Minimalist Blueprint use this digital cash most efficiently?
For the intentional investor, stablecoins provide essential, instantly deployable on-chain liquidity. They act as a hedge against currency inflation in emerging markets, offering dollar stability without the friction of a traditional bank account.
Right.
And more importantly, they can be deployed instantly into yield-generating investments or used for real-world transactions through hybrid wallets that connect the blockchain to legacy financial systems. We're removing the bureaucratic friction inherent in cross-border payments or those slow, cumbersome bank wires.
Now let's move to a concept you mentioned earlier, the power of yield stacking. We need to go beyond just basic staking and talk about staking evolution.
Traditional staking meant locking up an asset like Ethereum, ETH, to help secure the network and own rewards. But that asset then became illiquid for the whole duration of the lockup.
Right, you couldn't touch it.
Exactly. The 2026 standard is liquid staking. You lock up your ETH, but in return, you receive a derivative token. Let's call it STIF, or an LST, which represents your locked asset plus the accrued yield.
So I get the staking rewards, but I also retain liquidity because I have this tradable derivative token. So what can I do with that liquid token?
That is the core innovation. You can use that derivative token, which is inherently yield-bearing, as collateral in other DeFi applications. For example, you can take your STIF and deposit it into a decentralized lending protocol like Aave to borrow stablecoins,
Okay.
which you can then use to buy more ETH or deploy into those RWA tokens we talked about. You're earning yield from staking while you're simultaneously earning yield from lending. It's a form of capital efficiency that is simply unparalleled in traditional finance.
That sets the stage perfectly for the ultimate set it and forget it strategy, automated vaults. Now, this sounds incredibly complex, but the goal here is simplicity for you, the investor.
Exactly. Automated vaults are sophisticated smart contracts. It's pure code designed for the passive, minimalist investor. They function as programmatic fund managers.
So instead of me manually checking various DeFi platforms like Aave, Compound, Uniswap to see which one is offering the best lending rates,
The vault does it automatically, 24/7.
so the smart contract is constantly analyzing rates, transaction costs, risk parameters, and it's shifting my capital to chase the highest risk-adjusted yield for me.
Precisely. It maximizes the efficiency of your capital deployment. And this dynamic creates the concept known as composability. You can think of these DeFi protocols as financial Lego blocks. The yield-bearing token you get from one protocol is engineered to be the input for the next protocol.
Give me a tangible example of that composability, that yield-on-yield effect.
Okay, let's say you deposit your stablecoins into a vault. The vault automatically lends them out on platform A, giving you a receipt token. That receipt token, which is already generating yield, can then be automatically collateralized on platform B to generate a third layer of return.
So the system just compounds automatically.
It accelerates growth without requiring constant manual oversight or bureaucratic approval.
It's providing institutional-grade yield access, something that used to require massive hedge fund infrastructure, to anyone with an internet connection, all governed by transparent, auditable code. You've removed the manual oversight and maximized the returns on the capital surplus you generated from the radical frugality phase.
But a wealth blueprint is only as powerful as the stream of income that feeds it. We cannot discuss 2026 without a serious in-depth consideration of how AI is radically reshaping the labor market. The Minimalist Blueprint requires a proactive, aggressive strategy to maintain your earning power.
Right. And the sources highlight the exponential rise of what they call agentic AI, these autonomous systems capable of solving multi-step problems, automating data analysis, generating complex content, and even performing basic coding functions with minimal human input.
And this creates a very unique threat profile. The disruption isn't targeting physical labor initially. It is disproportionately displacing codified knowledge.
Okay, define codified knowledge for us.
It is the knowledge that is easily written down, easily taught in a classroom, and based on formal training, rules, and repeatable processes. Think of the younger worker, maybe an entry-level financial analyst or a junior software developer, whose primary output is just organizing, summarizing, or manipulating data using standardized procedures.
And the sources show this is having a measurable impact on job security already.
It is stark. We are already seeing a 13% relative decline in employment for younger workers, ages 22 to 25, in occupations that are heavily exposed to autonomous systems like basic data processing and certain areas of software development.
Because AI can just ingest the textbook and operate at the level of a recent graduate almost instantaneously.
Pretty much.
So if AI is mastering codified knowledge, what is it fundamentally bad at, and what should you be investing your time in?
It struggles profoundly with tacit knowledge. This is the practical judgment, the intuition, the accumulated experience, and the high-order nonlinear reasoning that defines true expertise. Tacit knowledge is learned through repetition, failure, mentorship, and deep interaction with the real world. It cannot be scraped from the internet.
Give us an example of how tacit knowledge creates an earnings hedge.
Well, compare an AI that could draft a perfect legal motion that's codified knowledge to a seasoned trial lawyer who knows exactly how to read a jury, when to press an issue, and when to pivot based on a witness's body language.
Right.
The latter is tacit knowledge, and it is irreplaceable. Or think of an experienced surgeon versus a robotic assistant. The robot performs the precise movements, but the surgeon uses decades of judgment and intuition to handle the unexpected physiological crisis.
So the blueprint solution is aggressive. Aggressive career upskilling. We have to invest in our human capital as diligently as we invest in our digital core.
We have to shift from competing with AI to learning to govern it. The focus is on AI augmentation. By 2027, half of all AI-enabled enterprise applications will require new oversight roles. These are human-centric jobs dedicated to the governance, risk, and accountability of AI output.
So these are the human auditors, the ethical reviewers, the data quality governors. They're not writing the code. They're managing the outcome and the risk of the automated system.
Exactly. These governance roles are highly resilient. And furthermore, the roles that require physical interaction, complex localized decision-making, and high-trust human relationships will remain paramount.
Right.
The sources highlight the continued intense need for skilled labor in industries like construction, where physical automation is slow and human experience is paramount. And, critically, mentorship and complex care roles in healthcare.
So the AI hedge isn't about fearing the technology. It's about investing in the skills AI cannot replicate: judgment, intuition, and oversight, to ensure your primary income stream remains robust, high value, and capable of funding your lean wealth machine for decades to come.
That's it.
We've covered the macro environment, the behavioral guardrails, the strategic asset allocation, and the human capital hedge. Now let's wrap this all up with the actual step-by-step roadmap, the 2026 implementation roadmap. This is a structured, three-phase approach designed to be executed over the next 12 months.
Phase 1 is all about defense and foundation. It happens in the first 3 months and is focused entirely on creating that intentional capital surplus.
Phase 1, foundation and defensive positioning, months 1 to 3. First, perform a judgment-free audit of your current finances. Track every single dollar in and out using that zero-sum mentality. Identify that extra spending that crept in, the leaky subscriptions, the impulsive dining, the unnecessary upgrades. That's where your new capital surplus originates.
Next, establish a robust emergency fund. You should aim for 3 to 6 months of essential living expenses. And critically, we want this fund working for you, not just sitting idle. Hold it in a high-yield savings account or leveraging our digital core concept, a tokenized U.S. Treasury fund, to generate real yield and maximize security.
And finally, lock down your behavior. Automate the pay-yourself-first principle. Set up automatic transfers for retirement accounts and investments that fire the instant your paycheck hits your bank account, before the money even touches your regular budget. This just eliminates the possibility of spending it accidentally.
Then phase 2, months 4 through 6, is where we introduce the intentional velocity of radical frugality.
Phase 2, optimization and radical frugality, months 4 to 6. This is the core engine of your capital accumulation. Commit to the season of sacrifice. Dedicate these 3 months to maximum saving by severely curtailing all non-essential spending. View this as a deliberate capital generation period, designed to rapidly hit the minimum thresholds you need for sophisticated asset allocation.
And while you're in this intensive period, conduct a ruthless subscription audit. Cancel any unused memberships and recurring charges that do not directly align with your long-term values. This is low-hanging fruit, but those small leaks really compound over time.
And keep your eyes on the prize by maintaining momentum. Establish quarterly milestones. Break down vague yearly savings goals like save $12,000 into concrete, manageable checkpoints like $3,000 saved per quarter. You've got to celebrate those smaller wins to maintain the motivation required for radical frugality.
Finally, phase 3, months 7 through 12, is the execution phase where deployment and sophisticated growth actually begin.
Phase 3, strategic allocation and growth, months 7-12. If your foundational capital meets the necessary minimum threshold for your platform, which is typically between $20,000 and $250,000, it's time to deploy into direct indexing. Transition your core equity holdings to an SMA setup to maximize the tax loss harvesting benefits we detailed. This makes your existing capital work smarter.
Simultaneously, you need to establish the digital core. Allocate 30 to 50% of your risk capital into a lean, institutional-grade portfolio anchored by Bitcoin and Ethereum, supplemented by high-conviction RWA tokens that offer tokenized access to stable, real-world cash flows.
And ensure that every single dollar is productive. Integrate automated yield. Utilize DeFi lending protocols or automated vaults for your stablecoin reserves and liquid staking tokens. This ensures that even your cash positions are generating real, compounding, institutional-grade returns 24/7 without requiring constant manual oversight from you.
So the 2026 Minimalist Wealth Blueprint is an intentional two-part strategy. It's about creating a massive, predictable capital surplus through radical frugality, that intentional underconsumption, and then deploying that surplus efficiently into customized, transparent, and yield-maximizing assets.
That means direct indexing for surgically precise and tax-efficient traditional equity exposure, and a lean digital core focused on institutional-grade assets, BTC as the scarce ballast, ETH as the settlement utility, and RWAs for access to stable real-world yields. The success of this blueprint is truly defined not by the volume of your possessions, but by the autonomy of your time and the transparency of your wealth.
We managed our minds by building those behavioral guardrails. We managed our spending by embracing sacrifice. And we managed our allocations by choosing efficiency over complexity. The wealth machine is set to run leanly and automatically.
Now here is the final provocative thought for you to carry into the rest of your week, tying this entire deep dive together. If your wealth machine is fully automated and running lean, if you have achieved that financial freedom and autonomy, what intentional and unburdened pursuit will future you in 2026 finally have the time, energy, and freedom to dedicate themselves to? Think about that purpose beyond the portfolio.
Thank you for joining us for this deep dive. We encourage you to explore the original source material and subscribe for more insights on building your financial future.
We'll catch you next time for another deep dive.